Welcome to this video series about measuring value creation in private equity, where we talk about 5 big mistakes that GPs make when they set numbers to limited partners and prospective LPs. My name is Mike Reinert. I've worked in the industry for over 15 years. I wrote the book Private Equity Value Creation Analysis, and I run the AUXILIA Mathematica and ValueBridge.net websites. These videos cover findings from my work, and they're designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it is helpful to you, subscribe and check out the website where you can download an Excel file behind every episode. This is video number 16 in the value creation series, where we begin to shift from theory to application. We have already shown you the best value creation equations and spent much time discussing how to use them and interpret their results. But we are not always in the driver's seat. For example, if you're a GP, you may receive an email like this. Dear GP, congrats on the successful sale of Bravo Company. Could you kindly send me the purchase price, exit EBITDA, net debt, and your fully diluted ownership at closing? It is highly likely that the investor will use this data to run some form of value creation analysis where they try to understand investment manager skill or GP value add, especially if they add, P.S. please send us those values at entry. GPs need to consider these requests carefully and not just let the first-year analyst send out whatever number he thinks are best. While we cannot know the LP's mathematics, based on the data requested, the model almost certainly has an EBITDA growth value driver, a multiple expansion value driver, and one or more value drivers that reflect balance sheet changes like cash flow generation, gearing, or the leverage effect. Now, we showed that both EBITDA growth and multiple expansion are comprised of market-driven and company-specific causes. For example, within EBITDA growth, we have the company-specific value driver market share growth that we covered in video VC116. And within multiple expansion, we have the company-specific value driver intrinsic multiple expansion, which can come from buying at a below-market entry multiple, selling to a strategic, or materially improving the quality of a company's revenue or earnings. We covered this in video VC112. The mathematics behind these value drivers are not difficult, but we can't assume that the LP makes such distinctions. Quite often, researchers will attribute 100% of EBITDA growth to investment manager skill or GP value add, and 100% of multiple expansion to broader market forces or luck. Sadly, this lazy interpretation occurs even in the academic literature, so all else being equal, it is generally better for the GP if more value lands in EBITDA growth and less lands in multiple expansion. Fortunately, GPs have some control over this. Regardless of what model is being used, EBITDA growth is always proportional to delta E, the difference between entry and exit EBITDA. And multiple expansion is always proportional to delta M, the difference between the entry and exit multiple. So, making yourself look like a more skillful GP with more EBITDA growth and less multiple expansion is as simple as providing numbers that give bigger delta E's and smaller delta M's. Now, that sounds a bit manipulative. I certainly do not advocate for GPs fudging their numbers to artificially inflate certain value drivers. However, in my experience, many GPs are already doing this, but in the opposite direction. Because of certain biases, GPs tend to send LPs numbers that artificially deflate delta E in EBITDA growth and artificially inflate delta M in multiple expansion. These biases are what I call the 5 mistakes, and they include understating entry valuations, overstating entry EBITDAs, overstating exit valuations, understating exit EBITDAs, and neglecting holdback and escrow discounts. I think that you will be surprised to see how much of an impact these mistakes can have. We'll start with an investment that has an EBITDA growth to multiple expansion ratio of about 1:1, and then watch that change to 9:1 after we make our corrections. Okay, here are the basic value creation mathematics that we summarized in video VC115. It has EBITDA growth, multiple expansion, gearing, cash flow generation, and fund ownership impact. That last one is equity value to the fund driven by GP dilution or concentration. We'll set a few constraints to simplify the math. First, we'll assume that the GP owns all the company equity, so fund ownership percentage is 100% at entry and exit. This makes delta phi go to 0 and fund ownership impact also go to 0. Further, because the average phi is 100%, we can drop that term from the other value driver equations. Second, we'll assume that net debt is 0 at both entry and exit. That makes delta ND go to 0 and the company's average holding period debt ratio go to 0. So both cash flow generation and gearing also go to 0. Further, because that means the company's average holding period equity ratio must be 100%, we can also drop that term from the value driver equations. This leaves us with only 2 very simple value creation components, EBITDA growth, which is the change in EBITDA times the average holding period valuation multiple, and multiple expansion, which is the change in the multiple times the average holding period EBITDA. Great, with that, let us set our baseline example. For total enterprise valuation, GPs often use the purchase price. So here it's $100 million at entry and $210 million at exit. We already said that net debt was zero, so the total equity value is equal to the total enterprise valuations. This gives us $110 million of equity value creation and a 2.1x gross multiple of invested capital. Over the holding period, we'll grow EBITDA from 20 to 30 million. So the entry multiple is 100 over 20 or 5.0, and the exit multiple is 210 over 30 or 7.0. We see that EBITDA grows by 10 and has an average value of 25 million, and the valuation multiple grows by 2.0 and has an average value of 6.0. That makes equity value creation driven by EBITDA growth 10 times 6 or 60 million, and equity value creation driven by multiple expansion 2 times 25 or 50 million. They add up to the expected total of 110 million, and relative value creation for EBITDA growth and multiple expansion are 55% and 45% respectively. Okay, this is our baseline. Now let's look at how much of those 5 mistakes can influence the split between EBITDA growth and multiple expansion. Mistake number 1 is understating the entry valuation. It typically comes from using purchase prices for TEV. This value is missing the transaction fees and expenses, which would make it higher, and working capital adjustments, which could move it either higher or lower. Let's look at the sources and uses. On the right, we have the $100 million purchase price. I think that analysts tend to use this number because it's the one that gets discussed most often. Buyers and sellers even sometimes mention it in press releases about deals. However, it does not represent the company's value. At the very least, we'd have to add this working capital adjustment, which is additional consideration that the sellers receive for the company. But the transaction fees and expenses also represent seller consideration. It's just that the sellers don't get to keep it. They use that to pay the bankers, lawyers, and the service providers. The company's total enterprise valuation in this case, then, would be the sum of these values, $104 million. I think that is a little easier to comprehend over on the left side. This is all the equity and debt capital that was used to fund the transaction, and if you were to look at the company's cap table and balance sheet on the first day of its holding period, it should look almost identical to this. $104 million is the correct entry valuation starting point for a value creation analysis because it is what the buyers own on the first day of a hold. In contrast, this purchase price is just a number that deal professionals put into a purchase agreement. It's a reference point for negotiations and helps them keep track of adjustments. It's not a real enterprise valuation because it doesn't tie to the dollars wired back and forth between the bank accounts of buyers, sellers, and other stakeholders. For that, we generally use these total capital values at the bottom of the tables. Now, in our simplified example, we don't have debt or co-investors, so the sources look like this. The starting total enterprise valuation and total equity value are both 104, and this means that the entry multiple is a bit higher, 5.2 instead of 5.0. When we calculate our value drivers, we increase EBITDA growth to 58% of value creation and decrease multiple expansion to 42% of value creation. Not a huge move so far, but that's just the first step. Mistake number 2 is overstating the entry EBITDA, and this is a little easier to explain. We should always use an entry performance metric that has a TTM date that is as close as possible to the transaction date and is as unadjusted as feasible. Quite often, GPs base valuations on forward or full-year estimates even when deals close mid-year. And occasionally, they cite highly adjusted EBITDAs, pro forma for anticipated contracts or hypothetical synergies that may never happen. Now, I don't think that any of this is being done with nefarious intent, it's just the way that they look at the deals. Those EBITDA timeframes and pro forma adjustments will always be disclosed in the investment committee memos. But it is a really bad idea for the GP to send that number in the LP data request because it pulls a lot of value out of EBITDA growth and moves it right over to multiple expansion. For example, let's say that this deal has a true entry EBITDA that is only 10% lower, $18 million. That moves the entry multiple up from 5.2 to 5.8x. When we use that to calculate our value drivers, we'll increase EBITDA growth to 72% of value creation and decrease multiple expansion to 28% of value creation, and that's quite a significant move. Mistake number 3 is overstating the exit valuation. This also comes from trying to peg TEV to a purchase price, and it often leads to other side effects when analysts try to balance the numbers by stuffing transaction-related adjustments into a company's net debt. Let's look at the equity proceeds for selling a similar company. We'll start with a sale price of $210, but of course, the GP doesn't receive $210. First, we have another $1 million working capital adjustment. This one goes against the seller, which in this case is the GP. Then we have $4 million of transaction fees and expenses. We'll assume that there's $5 million of cash on the company's balance sheet. This the seller gets to keep, but change of control requires them to pay off company debt, which is $15 million. For fun, we'll add a few more adjustments. We need to pay a partial month of interest on the debt, plus a small prepayment penalty on the loan, and let's say that the transaction generates a foreign tax liability of $500,000 due to change of control. In such a deal, equity proceeds would be $194 million. This is the exit total equity value, and you can't argue with it because this is what gets wired to the shareholder bank accounts. But what about the exit enterprise valuation? Well, in an effort to force transaction capital to match a purchase price, analysts sometimes treat all transaction-driven deductions as liabilities so they can jam them into the net debt number. Here they would total $16 million, so equity proceeds of $194 and net debt of $16 would get us back to $210. Unfortunately, that's the wrong way to do it. We're trying to understand the regular movements of holding period capital structure and P&L metrics over the normal course of company operations. We have this company paying down debt and accumulating cash every quarter. 2 years ago, net debt was about 20, then 19, 17, 15, and eventually they get it down to 10 million. But then, on the last day of ownership, we jack it back up to 16 due to purely external factors that do not reflect normal company operations. It doesn't make sense. The transaction-specific adjustments like fees and expenses are more like shareholder liabilities than company liabilities. It is more appropriate to define the exit net debt as the sum of normal balance sheet items. In this case, it would be the $15 million loan, $5 million of cash, and perhaps this fairly inconsequential partial interest payment of $200K. This gives us a more reasonable exit net debt value of $10.2 million, and when we add it to the total equity proceeds of $194 million, we get an exit valuation of $204.2. This is really the best way to do it. For exit total equity, add up all the shareholder proceeds. For exit net debt, look at the balance sheet excluding any transaction-specific items. And then for exit valuation, simply add up those two numbers. You don't need to get hung up on that purchase price. Now, in our example, we didn't have any debt or excess cash on the balance sheet. Let's just say that we had $1 million working capital adjustment and the $4 million of transaction fees and expenses. That makes both the total equity proceeds and the total enterprise valuation equal to $205 million. And this drives the exit valuation multiple a bit lower, 6.8 instead of 7.0. When we calculate our value drivers, we increase EBITDA growth to about 75% of value creation and decrease multiple expansion to about 25% of value creation. Another small move, but again, one that shifts value out of EBITDA growth and into multiple expansion. Mistake number 4 is understating the exit EBITDA. Now, just like with the entry EBITDA, GPs should always strive to provide a performance metric with a TTM date that is as close as possible to the transaction date and one that is unadjusted as feasible. We really don't have an issue with deal professional bias here. What happens is that when the LP asks for a number, the analyst might send out the last set of audited or approved financials for a company, but those are often stale by 3 or 4 months. Lagging financials typically understate exit EBITDA because 9 out of 10 times companies that successfully trade are growing at exit. This again will bias our value bridge. What the GP may need to do here, given imperfect information caused by the fact they no longer own the company, is estimate the TTM exit EBITDA. It can be based on a combination of actual and budget performance. Perhaps that's 9-month actuals and 3 months of budget, or 10 and 2, or 8 and 4. The GP should have sufficient documentation to support that number, and it will give the LP a much more meaningful explanation of equity value creation. For example, let's say that the actual exit EBITDA here is closer to $33 million. That moves the exit multiple down to 6.2. When we run the numbers and calculate our value drivers, we increase EBITDA growth to 89% of value creation and decrease multiple expansion to 11% of value creation. That is another very significant move. Finally, mistake number 5 has to do with cash holdback and escrow proceeds. Quite often, buyers require a portion of seller proceeds to be held back or placed in escrow and be subject to the company achieving certain performance goals under the new owners. That means that exit proceeds will be a combination of realized cash and unrealized equity, and the unrealized portion is often held at a discount, which represents a probability of sellers eventually receiving cash. Let's go back to the last example. Shareholders receive proceeds of $205 million, but only $195 of that is cash. What remains is a $2 million cash holdback and an $8 million escrow. We need to put appropriate discounts on these values, which will flow through to exit total equity, exit enterprise valuation, and the exit valuation multiple. The holdback is short term, maybe 6 months, and if the GP is highly confident about receiving it, they might only discount by 10%. Escrows are typically longer term, maybe 18 to 36 months. And they may depend on the company hitting specific revenue goals or certain customer contracts being renewed. Since they are more speculative, discounts are usually higher, perhaps 50%. That means that our exit total equity value is equal to the sum of $195 in cash proceeds, 90% of the $2 million holdback, and 50% of the $8 million escrow. This makes the fair market value of our realized and unrealized proceeds equal to $200.8 million. Since net debt is equal to zero, our exit enterprise valuation is also equal to $200.8 million, and that will move our exit valuation multiple lower here at 6.1. Following through with all the math, we increase the EBITDA growth to 92% of value creation and reduce multiple expansion to 8% of value creation. Now note that the final value drivers will continue to move up until that final escrow dollar is released. This can be a few years after the company is formally exited. For example, assume that the full holdback is released after 6 months, but the company is performing worse than expected, so the GP must mark the escrow down to 25% of face value. Running through all the math would change the value drivers as follows. Then perhaps the company rebounds, so the GP reduces the discount to 25%. This will change the value drivers once again. The lesson here is as follows. GPs cannot control what equations LPs use to understand investment manager skill, and they cannot control how LPs interpret their models. But GPs usually can control what numbers go into those models. It is in their best interest to avoid making the following 5 mistakes. All of them tend to shift value out of EBITDA growth, a value driver more frequently associated with investment manager skill, and shift value into multiple expansion, a value driver more frequently associated with broader market forces or luck. The magnitude of these shifts can be quite substantial. In our example, the biggest moves came from overstating entry performance and understating exit performance. This overstated multiple expansion by 29% and understated EBITDA growth by 29%. Together, that is a 58% swing in relative value creation. The capital structure mistakes were not as impactful, but they are still material. In our example, they combined to overstate multiple expansion by 9% and understate EBITDA growth by 9%. Together, that is an 18% swing in relative value creation. I hope that you found that helpful. There was a lot to cover, so we went through the mathematics quickly, but you'll find all the tables, equations, and an Excel template on the VC116 episode page at AUXILIA Mathematica. If you are interested in this sort of thing, please like, subscribe, and check out all the private equity value creation videos on the website. Registration is free and gives you full access to downloadable Microsoft Excel templates, articles, white papers, online value creation calculators, and other content. Also, don't forget to check out valuebridge.net. If you're not so interested in all the mathematical proofs and theories and you just want to get a model up and running in the next hour or two, valuebridge.net will be your best bet. Thanks for watching. I hope to see you at either AUXILIA Mathematica or valuebridge.net.